Good afternoon and welcome to Brightday's final webcast for the year. My name's Kirsty Spicer and I'm the Content Director here at Brightday, and with me today we've got Eureka Reports Equities Analyst James Sampson. Thank you so much for joining me, James.
Pleasure, Kirsty.
Now today we've got quite a bit to get through, so we're looking at talking about income in retirement. We're going to be drawing on James's expertise about what kinds of shares would be looking to deliver good, consistent income for your portfolio in retirement. Also how you'd structure your portfolio and what are some strategies you can employ to make sure that you can weather both the good and the bad times without giving up too much capital or missing out on too much return. The reason why we picked this particular topic is we had a couple of questions come in about what is the future of BHP's dividend. I'm retired, so it sort of marks a really good place to kick us off. Yeah. There's been quite a bit in the press about BHP and the future of their dividend. Yeah. I guess the most interesting thing is that they've said that they've got a progressive dividend policy, but we need to address what that is and what issues surround sort of committing to a progressive dividend policy.
Yeah, so BHP define their progressive dividend policy as that they'll deliver at least what they delivered last year, and there's some mechanics around that sort of whatever they paid in the full year, they'll pay in the half year at least and then grow it again in the full year. So during the good times, that's great, and they can do that because through a commodity super cycle that we all know has ended, you know, when they're making lots of money, they had plenty of headroom to pay dividends on an increasing basis without putting constraints on the company's balance sheet effectively. They had the money to do it. Now that commodity prices have crashed and BHP is making significantly less money, an absolute return, like a progressive dividend policy, which is stating an absolute number as against the percentage of profits that will pay out, that can be problematic when you're making significantly lower profits. So, you know, a progressive dividend strategy is a good thing, providing that the company's cash flow and balance sheet is there to go through with it and pay it over time. And that's the real risk to investors.
Right. So is it common for Australian companies to commit to a progressive dividend policy?
It's not common. It had become a little bit more popular in the last few years. More companies will provide a payout ratio or a stated range of a payout ratio, which of course is a percentage of profits that they'll pay out. And that obviously fluctuates year on year. BHP's policy, you know, it has been good for investors. It's provided some certainty and clarity into the future. But as I said before, an absolute number like that is quite dangerous when profits fall. And I think we've seen in the press how that's playing out and how analyst expectations, the market's expectations now are for them to not be able to keep that up. And even some of the rhetoric from BHP at their AGM was that, you know, this stuff might be under review.
It was interesting. It sounded like they were preparing to hit investors with a lower dividend at some point in the future, sort of softening them up.
Look, our expectation is that the dividend is at risk. It's not really the type of stock that I think is a good income investment, to be perfectly honest. And I think resources companies, in and of themselves, don't lend themselves to good income investments. The fact of the matter is that their profitability is driven by iron ore prices or coal prices or whatever commodity price, and we've seen in the last 2 years that their ability to pay income can be driven by the price of that commodity, of which they have no control. So, you know, really we want to be looking for companies that have recurring income, good certainty of cash flow and good visibility on the dividends into the future.
Is there anything else that makes a good income stock other than those last 3 points that you mentioned?
There's plenty. So
do you want to give us like a little bit more colour behind that?
Bit of a roundup, sure. Look, I think what we look for is not only a good yield, you have to start with a good yield. There's no point buying an income stock.
What's a good yield? What should I be looking at?
Sure. So I would put a minimum across the current market at 4% plus franking.
Okay.
Now that's not too high, it's not too demanding, but what you're giving up in yield you should be looking for in future dividend growth. Because you could go and pick a bank, say, that's yielding 6, 7, 8%, but they're not likely to grow their dividends past where they are right now by more than a couple of percent a year. You know, BHP is yielding 10% plus if you believe forecasts, but again, there's risk to that. So what you would prefer is to give up a little bit of that forecast number for certainty that the dividend will be higher next year or the year after. So what we really want to look for are the drivers of higher dividends in the future. And that comes down to assessing the company's profits, the company's outlook in terms of growth in its own business, the company's dividend policy itself, and the company's cash flow is key as well.
Right. Now, do you have any examples of a good company, of a company at the moment that reflects everything that you just said?
Yeah, absolutely. Perhaps, so the income first model portfolio has about 10 stocks in it at the moment that all fit the bill on those factors. One in particular I think looks quite strong, or two. I'll give you two examples that we actually wrote about in the Eureka report yesterday.
Yes.
Automotive Holdings is a car dealership owner and aggregator, and they're slowly going around and buying Australian car dealerships, and they're achieving good profit growth year on year, and they have been for a long time.
Yes.
They have a very solid market share and a good look through on sort of recurring levels of income. And they've paid a growing level of dividends for quite a while now and have a good track record. They just delivered a 4-month trading update showing that operating profit grew by 14%. Now that's what's going to drive a dividend growth in FY16.
Yes.
So the yield on that is close to 5.5%, 6%.
Right. Pretty tidy.
Yeah, very tidy, and it's a very solid company, and the share price might provide some growth as well. So I think it's a good, solid income investment, whereas you're not taking the same amount of risk that you would be in something like BHP.
So is that history of paying an increasing dividend, how much weight do you give that to when you're looking at a company?
Yeah, look, it really goes to the track record of what they're paying out versus what they've earned in terms of profits, and the ability for them to sustain that. So if you can see the dividend growing in tow with, say, earnings and cash flow, so they're making enough profit to pay the dividend, and then the cash is coming in the door to pay the dividend and still invest in the business. Once you've got that track record, the next question is, will that continue into the future? Is there anything that might disrupt that?
Right, so good points to look out for. Now we've got some questions coming through, and there's some crackers in here, so I think we should get started. So got a question from a guest. He'd like to get your thoughts on targeting stocks that have both an income and a growth characteristics rather than one or the other. Are stocks like DWS that are in two of your model portfolios the best choice for stocks in retirement? I, for one, like the fact that we're already thinking about income and growth, and not just one or the other, but I'll let you answer.
Yeah, of course. So look, I think there's a very key thing to think about, and that is suitability. If you're an income investor, you should be looking for stocks that will provide you income as a larger component of their total return. But every investor should be thinking about total return.
Absolutely.
So if you're thinking about income, you can't be blind to the capital value of your asset. So, I keep coming back and harping on about BHP, but if you were going to invest in something like that that's going to pay a good yield, the yield is a function of a falling share price, and you're eroding your capital. So DWS is a good example where there's a very good total return argument and a very good yield. And to be honest, all of the stocks in the income portfolio have the same attributes. DWS probably is just going through a little bit more of a phase and is of a market capitalisation and niche that also fits the growth portfolio. I don't think it's necessarily better, but it certainly has suitability for both types of investors.
Well, that's a rarity. To find those companies that are both income and growth, and I guess you're sort of looking down the smaller end for them. You're not going to be getting that from the big blue chips. Yeah,
precisely. Well, they're countervailing and competing forces within a company. A company, once it's paid back its debt, has two choices. It can either reinvest into its business to buy other businesses or buy new machines or whatever it might be to grow its operations, or it can pay out dividends to shareholders. A balance there is key, and some companies will go really hard on growth and pay no dividends. Others will, if they're at a mature phase of their business cycle, decide to pay out most of their capital as dividends. So investors need to be kind of thinking about what are the dynamics within the company I'm investing in, and how certain are those dividends and how certain is the growth given where they're spending and allocating their money. So seems easy.
No, it does. You simplified it, but it is much more complicated than that. Now, I've got a great question here from Bill. He says, should I buy Monadelphous for the dividend? And I feel this is going to come back to that capital preservation bit that you just touched on, but what would you like to add to that?
Well, it's a contractor. I've covered mining services contractors through what was the start of the big downturn in mining a few years back. And Monadelphous, there's no doubt it's best in breed. It's the best company in the sector. So there's an argument to say that if you want to bet on a turnaround or a survival of the mining services sector as we know it, and wait through what could be a 5, 10, 15, 20-year down cycle, it's the one company that I would have some confidence in. But I don't think that you should be taking that sort of risk if you're an income investor, because it could get a lot worse before it gets better. We just saw private capital expenditure numbers for the country, and investment is dying in that sector.
Pretty miserable.
Yeah, precisely. And Monadelphous really is a price taker. Their margins are being squeezed. They're a great company, but challenging conditions could continue for a long time, and the capital value could depreciate a lot before we start to see any turnaround there. So I would be looking elsewhere. I think give up a couple of percent, look for a 6% or a 5%, but something that you have less risk in.
That you're going to keep your capital
Precisely.
relatively stable. Well, I'm going to be coming back to ask you for some of your tips a little bit later on.
Sure.
We've got a question here from Mavis. She wants to know, I'm 84 years old, do not have an SMSF, small pension, and modest superannuation pension. And this is the crux of the question. Everyone, eventually, one has to sell assets for income. So is there advice about methods of selling shares given the capital gains tax due? Well, Mavis, we can't give you specific advice, but one of the best things about the superannuation system, and it's been in the press a lot, particularly late last week after Grattan Institute's report on super and tax, is that once you hit the pension phase, which is anyone who's reached preservation age and starts drawing in income from super, you don't pay any tax on either income that your investments generate or capital gains. So that's the facts there, and I'll leave it to you to work out where that sits with your actual own fund. David wants to know about APA. Please comment on APA as an income stock. It's rarely mentioned as a stable infrastructure stock. Personally, I don't know that much about APA, so I'll kick the ball to you.
Yeah. I haven't looked in detail at it, and there was some acquisition activity. I think they bought Energy Developments recently. They paid a good price for that. But look, it is a good income generator. The question is, is it just stable or is it going to grow? What I would think about in infrastructure, and we've struggled to find a really good infrastructure play that we like, is regulations. APA's assets are pipelines, and they have regulated returns that are reviewed by the government on an ongoing basis. I don't have clarity at the moment to the extent that I'd be confident in them growing their income into the future. Spark Infrastructure is another good one that again, it just lacks that confidence when these regulatory reviews being done by governments that really need money. It's just not a circumstance that sort of suggests expanding profitability into the future. So they're good income stocks, yes, and they're stable and they'd be good through the cycle, but are they the best way to put your money to work to generate income? Maybe not at the moment. Difficult ones. But again, I haven't looked at it in detail, so there might be more to it.
There's some good background anyway for the questionnaire for David to take away. Graham wants to know, do income investors or growth investors make more money overall?
That's a great question.
Go for it.
Well, it depends. I can't answer that in a straightforward way. Certainly, again, we need to think about total returns.
Absolutely.
But what you also need to think about is suitability. I would argue that it'll come down to your stock selection or your asset selection, to be perfectly honest. You can't broad brush it like that. At the moment, small cap growth stocks are performing really well, but over the last 5 years, they've been horrible. So in the last 5 years, I would argue that the higher dividend paying stocks have been outperforming and probably have been the better performers. A lot of that's to do with the big run the banks have had. When we're looking at a 5-year time frame. But over the longer term, it's probably pretty neck and neck, to be perfectly honest.
Yeah, exactly. On that point, I mean, it depends as well what period of time that you're looking at. I think income stocks for the past 5 years have had, a pretty easy ride. Interest rates globally have been falling, so investors have had no choice but to chase that yield, and sometimes you can get distortions of what things are actually worth. But who knows what's sort of going to happen out in the years ahead. One of the key points of how you build your portfolio in retirement is having a mix of stocks that are going to give you reliable income and having a few in there that are going to be able to grow your capital over time. The reality is you need both, because once you hit age 60, you might be living on your super, but you're going to live until 85, possibly 90, so you need to have assets in that portfolio that can help with that longevity risk of running out of money before you pass away, really. That's the reality.
Yeah. I would add to that it's important to perhaps not think of them as totally separate things to consider. Well. So, I mean, if you're an income investor, ideally you'd want to be at least growing your capital sufficient to offset inflation. So you're preserving your capital but still generating the income to live off. If you're a growth investor, I don't think you can ignore the fact that good returns from dividends that can be reinvested if that's the way you're inclined are a big piece of the total return.
Oh, absolutely. Yeah, it's definitely not one or the other.
Yeah.
This is a great question from Jim, and it's something that we were talking about earlier this morning. Will dividends be higher in the future or lower or the same?
Overall.
Overall, like there's no more to the question, so I'll let you add some colour or context.
Sure. I would suggest that overall, as an absolute number, they'll be higher as inflation, finally does kick in one day, and company profits do expand. I mean, the market is hopefully still going to be growing as it has been over the long run. So dividends will be higher. Will dividend yields be higher or lower? A lot of that dynamic will come down to the price action. We've seen yields perhaps contract a little bit as the market has become more popular. But you only need to look back to sort of pre-GFC days where the market was really riding very high and yields across the board were a lot lower to realise that what investors need to see from companies as a dividend yield is also related to bond yields that are being paid. It's related to other asset classes and how they're being priced. So looking forward, with interest rates potentially on the rise a little bit, perhaps the popularity of the stock market as a yield play over the next, say, 5 to 10 years might start to soften, and that might mean that stock yields need to be higher in order to justify investment for those that have other assets to choose from.
Good points. Now, this is a question from Jen. She's read yesterday's Eureka report on Dick Smith, but she's puzzled of how you could get a stock so wrong. Initial value of $2.40 3 months ago, and now it's 10% of this. So
that's the challenge, and look, it's been a terrible performance from Dick Smith, and we've decided to sell it out of the income first portfolio because we don't think they'll pay a dividend, or there's a good chance they won't pay a dividend now. And it's one of those unfortunate circumstances where when you're investing in the stock market, you're investing in companies, and companies are run by people, and people make mistakes. And I think Dick Smith has made some serious mistakes. As a retailer, the bread and butter of what you do is advertising and selecting what products to have in your store, and I think they've got that very wrong. What's interesting has been the pace of the downturn and the way that it's been punished by the market. So they came out with a trading update at the end of the September quarter, which basically was in line with our thinking, but they've said we've had a horrible October and downgraded profit guidance. Now that was okay because, even assuming the lower end of profit guidance, there was still a dividend there, and the share price had probably gone so far that it wasn't worth selling. They then came out yesterday and said, look, November's been horrible too, we can't give guidance, we're in real strife, and we've written down some value of our stock and we're getting things wrong further. When that happens and you've got no certainty, you can't hold on to it. It's no longer suitable for the portfolio. Now, there's a chance that we've sold this near the bottom, and it's been a poor trade, and it's destroyed a bit of value in the portfolio. The way to then think about that is to realise that it is a part of a broader portfolio. It's diversified. The income first portfolio has outperformed the market, even with Dick Smith, which is it's a great kind of point to bring up risk and diversification, and how investors need to be really cognizant of that, because we can get it wrong. Even I, who look at these companies, talk to the management team, go through my numbers and my forecasts with them, and have a high degree of confidence, generally can get this stuff quite wrong.
Absolutely. Now, because no one gets it right all the time, and even all of the fund managers that I've had in the studio with me so far this year and sat in your chair, say that we do get it wrong. Sometimes 30 to 50% of the time. It depends on the period, what companies and sectors they're looking at. So it does happen. But for investors at home, how much, if you're going for a single company, if you're going to buy direct companies like similar to the income first portfolio, but we're going to look a little bit bigger than that. How much do you think, in terms of percentage of a portfolio, should direct holdings make up?
So there's a really good kind of academic studies that have been done on diversification and the types of risk you're taking on when investing in a stock. So when you invest in a stock, you take on market risk, which is the macro ups and downs and day-to-days, but you also take on company specifics, which is the risk that Dick Smith will downgrade and fall apart. At about 15 to 20 company-specific risk, so long as they're quite well uncorrelated, if you like, i.e. companies that aren't exposed to the same risk.
You don't want to be investing 20 companies in the banking industry.
Precisely.
You want different sectors.
That's right. So providing you're taking on different risk in each stock, about 15 to 20 companies suggests that company-specific risk is near zero. So that's where you should be targeting, and that relates to about between 5 and 7.5% as a single stock exposure in your portfolio. So that's where we've generally targeted for the income first portfolio, somewhere in that sort of vicinity.
So that's a really good point that James has made for everybody at home, sort of between 5 and 7% in any sort of direct equity. And by the time you factor in that you probably should have, you might not, I won't be sitting here telling you what to do, but if you consider that you'll have some international shares, some fixed income and some cash, it makes up less of your portfolio than that 5 to 7%. But of course, everyone's different, and sometimes, you know, you want to back something that you believe in or that you're very familiar with, and that's absolutely fine. But it's always good to have rules of thumb, so to speak, and keep them in the back of your mind.
Yes.
Now, this is a good question from Rob. I'm getting close to retirement. Should I move all of my super into dividend-paying stocks? While we can't give you advice, I hope that what James and I have been talking about so far in this webcast, that it's not about just having income and growth and separating them out and looking at them in isolation. It's about sort of having a mix between the two and companies that can deliver both or have a tilt towards one over the other. Do you have anything
Yeah, I
to
think
add
you
to
should
that?
start from what your objective is. So if you say, I want X amount of dollars out of this per annum, you need to make sure that your portfolio is set up to achieve that before you look for other growth stocks and other things like that. And then and you also need to consider what you're giving up by targeting that amount of income per annum. So start with what you need, start with what your objectives are, and then pick the assets that will deliver that. Rather than hearing a hot tip and going for it, it's really about making sure they suit what you need out of your investments.
So work backwards. How much money have you got? How much income do you need? And how are you going to get it?
Yeah, precisely.
John wants to know, what is your view on hybrids like MQGPA or NABHA?
Yeah. Hybrids are fantastic at the right time in the market cycles, and there's some really good ones out there. Ramsay Healthcare Cares was a great hybrid that paid a huge yield.
I think it was yielding over 10% when it was first listed.
And a fantastic underlying company. So the key is that you've got to look at what are you investing in as an underlying company, what's the company that's paying the dividend out. And then unfortunately with hybrids, you do need to do some research. They're all different, and they all have different clauses. They all have different seniority compared to other forms of debt or equity. And they all differ, unfortunately. They're not apples and apples.
Correct.
My view is that at the moment, there's very few hybrids that are priced paying a yield premium that is sufficient, or are paying a yield that is sufficient to say, well, I want to be further subordinate in that risk profile to take that yield. You're better off taking the equity, in my view, right now in the market. That may change, but just where we are in interest rate cycles, that seems to be, you know, the position for most.
Yep. I can't offer sort of any specific commentary on the Macquarie note, but NABHA is a perpetual security, so NAB don't actually have to recall that at any point in time. And with perpetual securities, they have a propensity to trade well below their face value. And you know, NAB has traded as low as $50 during the GFC. I'm not 100% sure of where it's trading at the moment, but I do know it's well below its face value of $100. So buying those notes that are perpetual in nature means that there's no actual forces that would drive that price back up to its face value, and there's certainly no need for NAB to recall that note. So your capital value risk is high with a perpetual note. That's just one thing to keep in mind.
Yeah, well, it takes on a lot of the attributes of straight equity in some respects.
It certainly does.
When you look at something that's not redeemable. So, you know, and that's when it comes down to reading the specific features to making those calls. And so it's, I think it's something that you either need good advice on or you need to understand quite well.
Yes, and those PDSs are long and err on the confusing side. We talked about it with APA, but are there any infrastructure stocks you would classify as income stocks?
Yeah, there's plenty of them that are yielding 5+%. On my watch list is Spark Infrastructure.
Right. Okay. So you mentioned that before when you were talking about APA.
Yeah, a good. You know, it's a really good business that's performed well and provided close to a 6% yield over a reasonable period of time. The reason we've held off from bringing that into the portfolio just yet is that there's some, as I said, there's a lot of regulation that defines the returns that they can generate off their assets because they're, you know, public infrastructure assets effectively, and what I'd say about that is that you have to kind of understand where the risks are in terms of regulation. Spark's in the business right now of negotiating a regulatory reset, which will state their returns that they can receive on their assets. So we're waiting for that to wash out. I think they got a really bad outcome and they're now appealing that. So, you know, that's not the type of risk you want to take on in that type of company. You want to get them when they've got a clear sight.
If you are looking for infrastructure stocks as a way to generate some income and keep up with inflation, head to Brightday's featured fund section. We have 3 infrastructure funds on our preferred list of investments. So they have been the ones that have consistently paid out decent income to investors and at the same time have offered pretty impressive capital gain returns as well. Anne wants to know, do banks still hold the prospects of attaining growth and income? And which banks would you recommend?
Yeah, it's so no is the short answer. I don't think so.
Why?
The banking cycle is close to as good as it's ever going to get, at least in the last, say, 12 months or so. And payout ratios are near their upper end. So the banks are making as much money as they can in their current form, and they're paying out as much in dividends as they possibly can. And it's kind of the only way from here is down, to be perfectly honest. Growth is pretty flat in terms of lending growth, credit growth, and system growth of the banking sector. So, you know, in the past few years where we've been seeing 5s, 10s, and plus on the EPS growth, earnings per share growth side of things, we're probably looking to see sub 5% growth. When banks are issuing millions and billions more shares through either dividend reinvestment plans or capital raising to meet regulatory requirements, you know, Westpac's a perfect example. They recently announced a quarterly or a full year profit number that grew 4%. And I think they, in the same breath, issued a lot more capital to meet APRA requirements. They issued 4.3% more shares. So if you do the equation, they're actually per share making less profit.
Correct.
So it's hard to grow a dividend when you're making less profit per share unless you expand your payout ratio. The problem for these guys is they've pulled that lever and they're at the top end already. So, you know, I think, yes, banks are still good income plays. They'll still pay 6% and they're still quite safe. They're not about to collapse. But, you know, as the market changes, as interest rates lift and we demand more from our equity securities from an income perspective, there's probably better places where dividends are growing and we can get more foresight on that.
That's, I agree with everything you said, and I think it's really interesting that you said they've already pulled that lever to push their payout ratios. They don't really have much more that they can do to make themselves look more appealing to investors in the current light of things. And I think that once people catch on to the fact that they're paying out lofty dividends, but then they go and raise capital by issuing new shares, that there is some counteracting effect there. I don't think everyone's sort of caught up to that just yet.
Yeah, and look, I think it's okay that they're paying out dividends and then raising capital. A lot of the capital raising has been regulatory driven, so APRA's said you have to hold more money against your capital base. What that does is it actually dilutes the profitability of the company. So, and dividends are related to profitability directly. So I think when we can see all these big things happening, a lot of investors are blinded by 6% and ignore the fact that, well, that's bumping a ceiling, definitely.
Yep, good point. Susan has a question. Are high yield ETFs the way to go, or do you prefer individual stocks for retirees who rely on dividends?
I prefer individual stocks, but I'm an equities analyst, and that's, you know,
that's your job.
That's my job, and that's where I think you can also, you know, if you employ a little bit of time into it, I think you can also tailor things to your needs. So you can pick companies that pay quarterly dividends if you have a requirement for more steady income, or you can be in, you know, companies that are, say, more capital stable and you have better foresight. I think you can massage things to suit you better.
Yes.
That said, there are some really good ETFs out there and some really good LICs and managed funds out there that do pay wonderful yields. And if you're not of the type that wants to spend the time to make sure you're on top of things, then they're definitely viable options. Certainly Mitchell has some ETFs that he covers in Eureka Report that do have good yields, and there's some managed funds as well that you may be able to identify as well.
Yes. So in addition to what James has just said, the only other point I think that you should be aware of, Susan, is that you might be getting lofty incomes from a high yield ETF, but in terms of capital preservation, you're subject to the same market forces. All of those companies that are in there are sensitive to a bunch of similar factors. It goes back to what James was talking about before, when you have market risk and company risk. And you've got to look at your total return. So you might be getting great yield, but if the value of your capital is shrinking, you've got to make that trade-off.
And the thing as well to remember is you have to look at what's inside the ETF before you make a decision.
Correct.
So if it's just taking a broad look at the high yielding blue chip stocks on the market, it's probably way too overweight banks. It probably holds some BHP. There's probably some simple things as a self-directed investor that you could pull out of there that lowers the risk of that and maintains a good yield.
Yep, that's actually a good point. Definitely have a look at what they own. Now, for everyone who has signed up to attend today's webcast, we will be sending you out a copy of our retirement ebook. Now, it's got a bunch of stuff on the rules of when you can get your super and how much and how to go about doing it, but it's also got a section of how you build your portfolio. And in there we cover looking for stocks that just offer good dividends, and other ways and ideas that you can go about investing your money. So Susan, I suggest have a look out for that. Hopefully you find something interesting in there. Now, David wants to know, what are some companies offering good dividend yields of 4 to 6%? But specifically not companies on 8% with a falling share price. So I said I was going to hit you up for some stuff earlier on. So now is your time to share some of what you know with everyone.
Yeah, sure. So look, again, it depends on what sector you're in. There's definitely some sector biases at the moment as to where you find these companies, and I think it's important to, when you're looking at these, make sure you don't pick 10 consumer stocks or 10 non-bank financials. Certainly at the moment, I think there's some good non-bank financials that are paying good dividends that look quite good. Flexi Group is in our model portfolio and is a business that I think offers both growth and a decent yield. They're actually likely to pay a smaller dividend in FY16.
Okay. Smaller dividend in terms of dollar value than they did in FY15?
Yeah, that's right. But the reason for that is that they've just made a significant acquisition that will grow FY17's dividend significantly. So this is a perfect example where we're looking past the yield number itself on, say, a forward 1 year basis, and we're saying, is this a company that's likely to grow its profits and has a dividend policy that they'll continue that will mean that we're going to take a good income out of it for years to come? So the Flexi Group fits the bill really well. And on that note, I'd say there's quite a few non-bank financials that maybe aren't in the income first portfolio that do pay good yields. But again, you have to be mindful of diversification. On that note, I'm talking about a lot of these non-bank lenders like Credit Corp, Silver Chef. There's a lot of them out there. So I'd have a look at that sector. Collection House, another one as well. They're all on my watch list. But we try and pick the best from a sector to include in the portfolio.
Right. Is there anything else other than non-bank financials that you think have got that sort of 4 to 6% yield? Anything else catching your eye?
Non-traditional REITs or real estate investment trusts, I think are great. I have a little bit of a concern at the moment with traditional REITs, so office buildings, residential, that sort of general traditional property, in my view, has its challenges. But if you can find a niche REIT that invests in a growing sector and is developing or building or buying more property and growing on a way that's sort of accretive or adding to cash earnings per share and dividends, you could be on a real winner there. So Arena REIT is in our portfolio. They focus on owning and leasing childcare centres, and that's an area that there's a big expansion. We've probably all witnessed all childcare centres on every corner at the moment. Another one that's on my watch list is Generation Healthcare, GHC is the code there. And they own hospitals.
Yes.
I can't see the need for hospitals declining the way that perhaps office building or residential towers can have that pause, if you like. So I think, finding sensible businesses that have that growth that still are companies that do lend themselves to good yields, these are paying sort of, between 4 and 6%, but are likely to grow their distributions in years to come.
Well, there you go, David. James has given you 3 tips: Flexi, Corp, Generation Health, and Arena.
Yeah.
I think you kind of covered this off when we talked about the banks before, but we'll address this one specifically. Will CBA dividend and growth continue?
Look, it may and it may not. I think it's likely to stagnate, to be perfectly honest. I think they'll do everything they can to make sure they don't cut their dividend in the near future. Will the growth continue? Probably not. They're probably likely to see pretty sort of stagnant growth. So I'm talking that sort of 0 to 5% profit growth. But if you look at it on the fact that they may be issuing a lot of new shares through dividend reinvestment plans, if you look at it on an earnings per share basis, it may be flat if not small declines. And I think the market's still coming to reality with that. So I looked at Bloomberg forecasts recently for the banks in terms of what analysts are expecting from a dividend perspective, and they're still expecting, I think, 2.25% growth per annum in dividends.
Right, okay.
So it's pretty unexciting inflation-style growth. So it's a good income. Have they come to terms with the reality yet? Maybe there's some downside risk to those forecasts, I would say.
Now, when you said that you don't expect growth,
Yeah.
You mentioned earlier today that the banks are at the top of the cycle or at the end of the cycle. So, I mean, not expecting growth, is this sort of the next sort of 2 to 3 years? Is this a 5-year view?
Yeah.
I'm not asking you to project out 10 years
No.
by any means, but like what is the time that you'd be
Yeah.
putting on that no growth?
It's tricky, and it depends what they do next strategically. If they continue in their current form, they'll grow at the same rate as the system, if you like, so lending growth. And I think credit and lending growth is probably flat for a 2 to 3 year time horizon.
Right, okay.
As we see this interest rate cycle change, and then we'll see their response in the next 2 or 3 years. So, don't take them off the watch list. Don't be that worried about them. But certainly, I would put all my bank exposure on watch, if that makes sense, in the naughty corner of my portfolio. And I consider how exposed am I. The Aussie market is 48% banks. We need to be really careful if we're trying to outperform, if we're trying to create good income and be preserving our capital. Does that suit what I need out of my portfolio for the next 3 years?
Good point.
Can be tricky.
Very tricky.
Yeah.
Kate wants to know what makes, or how do I know if it's, I'll start again. If I'm thinking about buying a stock, how do I know if it's a reliable dividend player?
Yeah, and that's where a lot of work has to go into it from our end. There's a few things that we would look at. The history is one. It's always a good place to start. Has it been a reliable dividend payer in its history? The other thing that I would always look at is the payout ratio. So what % of profit are they paying out to shareholders? So
what is a good range? So the banks are close to 80%, if I'm correct.
Yeah.
Well, like, how much do I want to see a company paying out, and what's the lowest limit?
Yeah, so it's circumstantial to the company.
Of course it is. But give us some rules of thumb.
Right, rules of thumb, not above 100%.
Well, that would be a little tricky, but
there are some companies out there that will pay over 100% of their earnings just to maintain the dividend to keep the market happy. So that's rule number one. The other thing is to look at whether or not they're borrowing to pay those dividends as well. So I think rules of thumb, 60 to 80% is generally where a lot of the good companies are paying. But if it's a company like DWS where you can see that the cycle's turning and they're sort of being really poorly valued by the market, and they've got growth at low cost, so it's a non-capital intensive business, they pay 90%-ish looking backwards of their profits as dividends, and we're comfortable that they'll still grow their business whilst paying 90%. So when I say it's circumstantial, other companies like Monadelphous have to invest significantly in the working capital to run a project and get the profits out of it, so they can't pay 90% as dividends. So it really comes down to the type of business that you're looking at. Unfortunately, there's no simple rule of thumb there.
There isn't a rule of thumb, but if you're at home, what you could do is, if you're thinking about one particular company, is you could look at what other companies in that particular sector or similar companies are paying out as dividends.
I would look. So I would look for some easy indicators. Would be has the dividend grown with profit over the past, and do they have like guidance or expectations for profit in the future? And if yes, it's grown in tow and profits are expected to grow again, you can make a reasonable conclusion that they'll grow their dividend with that in tow with profits. That's the type of trend that we want to see: is growing profits driving growing dividends.
Question here from Ian. Do you recommend any Australian LICs for diversification income in an SMSF in pension phase? Example, BKI, WAM and Mirrabooka. If you can't answer this,
yes, I'd say they're reasonable things to think about. So, and look, it differs for every person, but I would definitely say it's a reasonable strategy to consider putting a core holding in a couple of these LICs that offer decent yields and good solid performance track records. Mitchell's written extensively about it for Eureka Report, and there's, WAM's paid a reasonable yield. BKI, I think the yield's nearish to market. And you could have a core holding in those types of well-diversified professional LICs, or even managed funds, and then look at adding to that with some of the other high-yield, more specific risk-type stocks. But I absolutely think there is a potential place for those in a portfolio. It's more an asset allocation question in some sense.
Oh, absolutely. And I mean, in terms of do we recommend any Australian LICs, James mentioned that we have an LIC portfolio. So you can just head to Brightday's featured funds and search for LICs, and they've got, and there is a list of our preferred LICs. BKI is on there, as is WAM. Mirrabooka is not, but that doesn't mean that it's not a good LIC. It certainly is pays healthy income and also invests away from those typical ASX 20 companies that BKI covers. And WAM and Mirrabooka are probably a little bit more similar than the BKI if we had to separate them out very broadly.
Yeah, Mitchell wrote a piece on the LICs and sort of their dividend reserves, their profits, and how they've gone over time. And I helped him out with a little bit of the data there. And I can tell you that WAM was one of the better ones, definitely, from a profitability perspective, how they pay out their dividends and how they manage their balance sheet to ensure that into the future, as was BKI. They've got very solid track records. So they're probably two of the better ones in there for income investors.
Got a question here from Charlie. Do LICs fall into the income category, in particular shares like TOP and AFI? So what do you know there?
AFI is very market tracking. They have a good track record, but you know, I don't know what they yield, and I'd suggest that, you know, if you want a core equity exposure and not put too much thought into trying to outperform, that's a good way to do it. It's not going to give you
option. It's
a safe, boring option, and you know, I'm not that excited about it because I think with a little bit of work you can create a lot more value. It doesn't take much to find something that we think's better, in my view. The other one, TOP, probably not. Yes and no. It's got more risk in it because the nature of what they do, this is the Thorny Opportunities Fund, the nature of what they do is sort of activist and quite concentrated investing. So they have only 6 or 7 companies in their portfolio, and they go in and they shake things up and they talk to management. They take a substantial position in it. Some of them go well, some of them go poorly. Some of them might take 5 years before they start to yield. So I would be a little bit cautious with that style of investment. Income investing necessitates more mature companies that are profitable and you know, likely to pay a recurring dividend as against things that need to be shaken up, turned around, and then profit come out of it.
It's a little bit more high risk.
It is. It's more private equity style activist investing. So I'd be a little bit, you know, not to say that Thorny's not going to pay a good dividend, but you know, the suitability of it isn't quite there.
It's not a traditional LIC. It comes with an extra set of things that you need to be aware of if you want to go down that path.
Yeah.
Now, on that note, we're getting the wind up from production. So thank you so much for everybody that has tuned in today. If you've got questions about either Brightday or Eureka Report, please hit the button requesting a phone call from one of our team and we'll give you a call at your chosen time. James, thank you so much for joining me and answering everyone's questions. And if you've got any questions, please feel free to email us. Otherwise, we'll see you in the new year.